started, right? So last week we covered the straddle, right? Now, what was the straddle? We were talking about the straddle in essence being the buying a call and buying a put at the same exact strike price, right? Now, I said on the other side, we had the strangle, right? A strangle is also a neutral option strategy in which investors hold a position in both calls and puts with different strike prices, right? So that's the difference. That's the biggest difference right there between a straddle and a strangle. A straddle is the same exact strike price, but with a strangle, it is different strike prices, right? So when we're talking about different strike prices versus the same exact strike prices, we're going to be talking about the straddle versus the strangle, right? And with the same exact expiration date. So same exact thing that we were talking about with the straddle last week. It works in the same fashion for the strangle, right? Now, before we were talking about for a straddle, we want to kind of buy a call and buy a put for a long straddle at the money, right? At the money. Now, these are a little bit different because with the long strangle, you kind of want to buy a call and buy a put, right? They're different strike prices, but really out of the money. So, for instance, if we're talking about, okay, let's just say I buy a $55 call, right? And I buy a $45 put, right? So I pay the 50 cents for the call. I pay 50 cents for the put. The current strike prices, let's say, are the current prices around $50, right? So this way I could kind of go $5 out of the money in both directions. One, the biggest difference between this and the straddle is now that I'm going out of the money, what does that mean for the option price or the actual premiums, right? The premiums are now cheaper, right? So when I talked about it last week, as far as the straddle, when I'm buying the same exact strike price, right, for the straddle, where I could buy at the money. When you buy it at the money, you're paying a higher premium for both the call and the put. Now, if you didn't want to take a higher risk for the straddle and didn't want to spend that much money on the at the money calls and puts, this is another situation where you expect volatility, right? Where you expect volatility and be a very dramatic move in either direction, but you now buy a call and put outside of the money. So this way it is now cheaper, right? The overall risk is now cheaper because instead of spending like $2 in total risk, I'm spending only $1 total risk because it's further outside of the money, right? So if I want to buy one call, I buy one put. If I buy two calls, I try to buy two puts, right? The same amount of legs that I buy in one direction is the same amount of contracts I buy in the other leg in the other direction, right? So this is a strategy that you utilize when you expect volatility, when you expect dramatic movements, but you are unsure in which direction, right? So just like I talked about before, it's very, very similar to the straddle, but it uses options at different strike prices versus the same exact strike price, right? Give me a thumbs up. Let me know if you guys are already tracking this, making sure everybody's good and paying attention so far. The biggest difference, like I said, from the strangle versus the straddle, right? The straddle was the same exact strike price versus the strangle is different strike prices, right? Is different strike prices. So there's the biggest difference between those two is you, in both scenarios, you expect a lot of volatility and the direction is unknown, right? And the direction is unknown. But if you didn't want to spend the higher premium price for the straddle because of you're buying it at the money, you could now go different strike prices outside of the money, right? OTM out of the money. That's now at a cheaper premium. How do you figure out what strike prices to choose? Right? Just as anything else, one, technical analysis, right? And two, you have to look at the options chain and understand, okay, what's there as far as your contract, your volume, your open interest, and what you actually think that it would actually get to, right? As far as my technical analysis says, okay, I have a resistance in $4 above my current price. I have a support at $4 underneath my current price. I have good volume in both directions, both on the call side and the option and the put side. So therefore, I want to buy those calls. Now, they don't have to be the same exact price, right? So I don't have to say, okay, the current stock is sitting at $50. So I go $5 call, $5 put. It doesn't have to be the same spread within those calls or puts. So I could have bought a $55 call and maybe a $48 put, right? It just annotates that they're different strike prices. So don't get it confused that you have to have the same width of the call and the put. I'm just using this as a reference to kind of be simple. Hey, $50. So I could go $5 out of the money in the call and $5 out of the money in the put, right? Just as a simple reference. But long as I have different strike prices, then it's considered a actual strangle versus a straddle, and the same expiration dates, right? And I buy the same amount of actual contracts in both directions, right? So just like I said here, investors use this actual strategy whenever they think that there will be really dramatic moves in either direction, but really unsure which direction is going to move in, right? So just like I was talking about last week, as if the stock was moving during earnings, right? During Fed meetings, during CPI data, right? And you could expect a huge volatility in either direction, but unsure which direction it's going to move in. This is how you could kind of play it out, right? This is how you can play it out if you're unsure, but you know you want to trade that specific security. Do you secure more premium on strangles? This straddle, since it's riskier, if that makes sense. Right, so the question over here is, do I secure more profits really with straddles or strangles? And it really depends on the move, right? Because if you understand some technical analysis and understand how options work, the further out of the money, if those out of the money contracts become in the money, my actual risk to reward ratio is greater for out of the money, right? So if there's a big move that out of the money is now in the money, that means my risk to reward is actually greater. So let's just say a straddle versus a strangle, right? And the stock current price is at $50. If I bought that $50 call and bought that $50 put, which is for the straddle basis, I probably would have paid a total of maybe $2 or $3 of total risk, right? But considering I now reduce my risk and I spend less because it's outside of the money, but then it runs all the way up to $60. Considering I only spent $1 versus the other one I spent $3, my actual reward percent, right? That ROI, return on investment percent, would actually be greater on the strangle than the straddle, because I risk less, if that makes sense. Does that answer your question, Sal? So you still make sure you have similar amount of risk in both puts and calls, so you don't actually have a bias. Absolutely. Yep. Yeah. So you want to, whatever the amount of calls you buy is the same exact amount of puts you want to buy, right? So for instance, let's kind of look at this stock over here, right? Not Square, but what had earnings today? CRM. Right? CRM, which is Salesforce. I'm going to put this on a 15-minute chart. This actually had earnings today. And if you could see here, I'm going to put this actually on a 1-hour chart. And I could see that, okay, CRM for this past week, right? For this past week, kind of been trading between a $66 range and a $60 support, right? So $66 resistance, 66 resistance point, all the way down to a $60 support base. So it was trading within a range for a whole week. But considering it had earnings, I could say, okay, I could buy a $70 call, or I could buy a $55 call because the current price closed around 167, right? It closed around 167. So I could have went out of the money in both directions. Now, come tomorrow when the market opens, if I have bought a 155 put and a 165 or $175 call, the 155 put probably will be zero, right? That actual contract, if I pay 50 cents for it, will probably now be at 1 cent or even a fraction of a cent, right? So I, in essence, kind of lose that position. But I would maximize my profit because I have an unlimited potential to the upside. And the current price is at 194. So if it still stays above that 175 or whatever that strike price is, I could probably make a couple hundred or a couple thousand%, right? A couple hundred, a couple thousand%. So this is a perfect opportunity of where you could have played a strangle, considering that instead of just going at the money, right, like a 165 call and put for a strangle or for a straddle, right? If I look at these contract prices, so if I would have said, okay, even if I would have played weeklies here, let me make this a little smaller so everybody could kind of see the strike prices and the premiums, right? So if I would have said, okay, the current price is sitting at 167, but at close, that 175, 170 kind of call, 165 call was $7. That 165 put was $5. I would have risked basically almost $1,200 on each direction, right? But if I would have bought that 155 put for $1.50 and that 175 call for $3.40, I would have only risked $500 versus the $700, right? So I would have only risked $500 versus $700, and then the reward factor would be greater because both of those contracts are now well into the money, right? Does that make sense? I played Straddle on CRM today. It should pay nicely. Hell yeah. There you go. Right? Absolutely. Let me know what was your ROI tomorrow. Come tomorrow. Let me know what's that ROI. I'm dying to know, right? But that's exactly how you play it. Because this had no clear movement in either direction for like the past week. It was just ranging as it led into earnings. So if I expected a big move in either direction, right, that's when I kind of want to buy it out of the money call, buy it out of the money put, and then long as it moves in a nice clear direction, right, with a lot of volatility and volume, just like what it said here, as far as if we expect a dramatic move, that's how we can maximize our profits. Our maximized potential profits is limited, because if I bought that 175 call and now it's all the way up here at 193, 194, that's $20 in the money. That'd be $20 in the money. That would be, right? That's gonna pay substantially. That is going to pay, right? So you figure when the market closed today, right, kind of at the money calls and at the money puts, right, they're around kind of $6, $7. So you figure that these 175 calls or puts are going to be around, so $20 into the money, probably around like $12 to $14. So that could almost be like a 400% return on my investment. Yeah, it is rare that it big techs kind of stay flat after earnings, right? If you looked at all those earnings that had today, right? We had CRM here, right? We had Snowflake had earnings today. Look at huge move down, right? So this one would have paid out on that put position, but I still wasn't under. I still didn't know the direction, and even the past 3 days they kind of went horizontal, right? So Snowflake had a huge drop off. Right? What else had today? Splunk had earnings today. Another dramatic move in both directions or either direction, right? So this is another way to kind of play throughout earnings, right? And I say this, I'm always one to say don't really play through earnings because it's very risky, and it is risky because we don't know exactly which direction it could go in. But if you're trading with profits now and you want to play through earnings, this is a perfect strategy where I can reduce my risk, right? I can reduce my risk by buying out of the money calls and puts, right? By buying out of the money calls and puts. And therefore, if they are having big moves, I have unlimited potential profits. Why I also know my max potential loss. My max potential loss is whatever price I paid for these contracts. So if that same scenario for CRM, right? So for CRM, the only way I can really take a loss and maximize my loss is if the stock stays flat like it was the past previous 3, 4, 5 days, right? So if the stock stayed flat and didn't move in either direction, then both of those contracts would probably be, pennies on the dollar. But considering that it did have a dramatic move in either direction, then not only am I going to overcompensate for that put that I bought, but then this call that is going to be deep in the money is going to be extremely, extremely valuable, right? Does that make sense with everybody so far? Everybody tracking that? Right? Let me know if this is making sense so far. Give me a thumbs up. Anybody have any questions? Please annotate it, post it in there. Yes, this is making sense. Just drinking some water. Gotta stay hydrated. Only one person to make sense with. Nobody else is there. Kind of lost some people. All right. I guess they don't like this. All right. But I'm pushing on anyways. Right. So our max potential profit is unlimited. Right. While we cap our loss with the money that we risk for the contracts we bought. Right. So this is the beauty of this actual strategy. One, I reduce my risk completely compared to the straddle, because now I risk less, because whenever you buy out of the money contracts, they're cheaper than at the money contracts, right? But yet the same potential is there. The same potential is there, right? One of my strategies, this actual, one of my biggest profitable trades, no, one of my overnight biggest profit was off of Strangle, right? I only bought like 3 contracts or 4 contracts of both the call and put. I risked like $400 on those 4 contracts, which was like 50 cents each, right? So I spent 200 on calls, 200 on puts. The next day after the earnings, those $400 turned into $18,000, right? So that return on my investment was very, very substantial, right? It was very, very substantial. From $400 to $18,000. I think initially when it opened, it was at $18,000, and then the price quickly adjusted, and I think I sold it for like $16,700, right? Because I seen it start to go down, so I just quickly sold it, took my profits, and moved on, right? I wasn't trying to be greedy. That was already a huge return on my investment. But that's what this strategy does for you. Is it something that you could do every single day? I don't really recommend it, right? But if I did have a good trading day, if I made profits, I see that Tesla, Netflix, Salesforce, CPI data is coming out with some type of news after hours, and I want to play it, and I have extra profits to kind of gamble with, right? Because that's what this is. It is a gamble. It is speculative, but it's speculative because I'm playing in both directions. So long as there is a dramatic move, right? Long as there's a big volatility spike in both the call or the bear or the bull or bear direction, then I should be able to make some type of profits. Right? The only time I would take a loss is if it stays flat. and then most likely both of those contracts sell off, right? So for instance, now can you break even in this scenario? Absolutely, right? So for instance, like I said, if I when one position overcomes the other, so for instance on that CRM, let's say I bought that call for 50 cents, I bought that put 50 cents, and they're both at so my total risk is $1, right? So let's just say the call went up to $1, the put is at 0. That is my break-even point, right? $1 and a 0 is still that $100, right? Or if the call is at 80 cents and the put is at 20 cents, that's still my break-even point, right? So just, you could still, right, still take a small loss and a small profit, right? It doesn't have to completely overcompensate the other, right? And now if it does, and this runs up to like $5 and this is 0, then I net profit basically 5x, right? I 5x my potential profit because I have unlimited profits. My loss is already identified by the total risk I have involved in it. So how does it work, right? How does it work? Let's say this is my $45 put. This is my $55 call, right? So anything over that 50 cents, right? Anything over that 50 cents I spent on the call and anything at 50 cents that I spent on the put, above that is profit, right? And those are my break-even points, right? If I break even on that actual position, if I break even on that position, if the actual stock stays inside that range where it's basically flat, and it doesn't have a volatile move, that's where I get that max potential loss of whatever it is that I spent for those contracts, right? About the earnings plays where you expect a big move either way, would you want the move to happen after hours only? Is there only a small move at market open the next day? Would you consider that flat? I only really, whenever I buy long straddles or long strangles, right? I only do that with earnings, CPI data, right? Same thing now, even with the Fed speaking, right? So when we go back and look at, we understand that Jay Powell comes out and speaks, right? And we have huge spikes in either or both directions, right? So for instance, let's just say this day here, right? Let's just say, okay, the market opens, some news is coming out, so I buy a call, I buy a put, it runs up, it spikes up, I could sell the call, take a profit, and still hold the put position, right? And then as that sells off, I could also ride that put position, right? And then make a profit on that put. So they could still work out in both directions if we have violent spikes, right? So it doesn't only have to be an earnings play. I could still do it in day trading as well, right? Especially because Jerome Powell likes to speak in the middle of the day, right? Around 2 p.m. Eastern time, 11 a.m. Pacific Standard Time, right? That's when they go out and speak. So right before that, as the stock is kind of flat, let's look up the last day that he spoke. I don't remember. Oh, here we go. Look at that, right? So as it led into it, even the day before, this was kind of flat, right? It was flat, 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 flat. Even in this hour time frame, right? Let's say it was flat. I could have bought a call, bought a put out of the money, wrote it up, sold the call, sold off, sold the put, and made money in both directions, right? So as you expect some type of news, even if it's day trading, I could still trade it, right? It doesn't have to be through earnings. So hopefully that answers your question, SE. Yeah, I mean, Coinbase last week, during the earnings? I know it had volatile. Let me see. Where was it at? Was this their earnings day here? Right, so it had big moves where it kind of spiked up and then kind of sold off right before the market opened, right? So it could have bought that position if I bought it right before close or even here. And then as a run up, then sold that call, right? Okay, I got it. All right. So if it stays flat through earnings and then it opens up flat, yeah, it obviously because I'm gonna lose. So if the stock, for instance, here, let's just say I bought it here and there's a earnings in the after hours, right? So if I bought it here at close, I bought a put and bought a call, but it stayed kind of flat and opened very flat, right? Both those contracts would probably be negative, right? Because I needed a big move in either direction. And not only did I lose time with the contracts now, but also if the news occurred during the after hours, what is also going to happen? I'm going to get that IV crush as well, right? That implied volatility crush, where now it's going to decrease the price of the premiums. So those contracts, that's why I would need a big move. So if it does open up flat, it absolutely will have a huge effect on those actual contract prices if I held it overnight. So it does move. It does affect it, right? Does that answer your question? Right, so that's the long strangle in a nutshell, right? Just like I talked about before, just like I said last week with the straddle, right? It's a perfect scenario where I'm willing to risk some money with unlimited potential profits, where I could also maximize or know exactly how much I could lose, right? The loss is already identified, but by the contracts that I bought, right? That is the most I could lose is whatever I spent to buy those contracts. So if you're willing to buy those contracts and risk losing potential on that money if the stock stays flat, then so be it, right? I'm not gonna do this on a full port, right? I'm not gonna do this as full portfolio, high percent in my portfolio. I'm going to risk what I'm willing to lose in this type of scenario or in this type of strategy, right? Because it has a great risk to reward ratio, unlimited potential profits, while only risking very minimal on whatever I spent to buy those contracts, right? So now there's a long straddle when I buy the calls and puts. Now, on the flip side, there's also a short straddle, right? Which is the same exact thing, right? But I sell out of the money call and I sell out of the money put. So what happens when I sell it? I now receive the credit, right? For writing or selling the contracts. So if I did this and I receive that premium, we already identified that that's the most kind of money I can make, right? Now, when I would do this and how you could do it is when you expect little to no movement in either direction, right? So if you expect the stock to stay flat, you could sell a call, sell a put. And long as it stays flat or little movement in either direction, little to no movement in either direction, right? Then you could kind of maximize your profit margin. Unlimited risk, like short straddle? Yes, it is. Yes, it is, right? Now, let's get to it, right? So this is one to kind of, if you expect no movement, little to no movement in either direction and capitalize on time decay and volatility, you could sell an out of money call and sell an out of money put, right? What's the max profits? Right, my max profits when I sell a $55 call, 50 cents, sell a $45 put, 50 cents. So the most money I can make is a premium I received. Unlimited rest, that is not for me. Yeah, right, there you go. Right. Like I said last week, it's still something I'm going to teach you, right? Still give you something in your tool belt, right? Max loss, unlimited, right? And I put it right there. Still very, very risky for whenever I sell that call and put. Now, are we gonna cover it next week? No, not next week. In like 3 more weeks, I think we're gonna cover what's called the iron condor, which is very similar to this. When you expect stocks to kind of stay within a range, right? So if I look at a stock today, right? So if we go back to CRM and I see that, this stock has been trading within this range for the last 2, 3, 4 days. So I could have sold a out of money call, could have sold an out of money put, and it had very little to no movement. So I could have kind of maximized that and then sold the contract or bought the contract back and closed it out before the earnings occurred. Right? Doesn't necessarily mean that I'm trading through earnings. I can see that the stock is trading within a range. I can now sell that call up here. I can sell that put down here out of the money. So as long as it stays within this range, that's when I maximize my profits, because to maximize my profits, I need the contract, right? It says here, base case scenario is that the underlying stock moves slightly up or down or not at all. If the stock stays between those two strike prices at expiration, then that's when I become a full winner and I maximize my profit margin, right? And I maximize that profit margin. So long as it stays between those strike prices, that's when I can maximize my actual potential profits. Right? It's just whenever they have violent spikes in either direction, that's where I could get unlimited losses, right? But if it's flat and going sideways, that's like a perfect time to do it, because those contracts are losing value on time. They're losing value on volatility, and every day they're decreasing value, and I could close it back and buy it back at any time, right? Does that make sense with everybody? That's not SC. I see the only one here commenting is SC. So let's see if anybody else is with me. Once again, we're still losing people, but I appreciate anybody else is on here. If you guys do have any questions, please feel free to post it in the comments, or ask away, right? Yeah, makes sense? No, it doesn't. It makes sense to you. You're like the only one responding. I don't know if anybody else left, but I appreciate you. I'm good. There you go. There he goes. In between you and Sal. Hey, they don't want to be notified. They don't want to be seen. They're here incognito. They don't want to. They're just here. They're probably on here learning. So this is where they could teach it and charge people. And charge people to learn, right? But yet they're over here trying to learn it from me for free. That's probably what's happening. Because I know some people that did that. I know people who've done that before, where they took my ideas and kind of use it for themselves and sold it and make money from it. There we go. I appreciate it. Good strategy for paper trading. I mean, it can be, right? Any strategy that you're learning, first and foremost, I always recommend to kind of paper trade and see how it works, right? To see how it works, how it fluctuates, where to kind of maximize your profits, right? Where to kind of maximize your losses. I'm here absorbing. I appreciate it. Thank you, Tammy. Thanks, Fausto. Thanks, Juan. Right? I know some of you guys always around and always kind of learning. And so I appreciate it. Thank you guys. Come work, get the best of them. Yeah, I hope so too. But we'll see. All right, so that's like your short strangle, right? It is very, very risky, because if it does sell off dramatically, or if it does spike up dramatically, then you can have unlimited losses, right? Then you can have unlimited losses. But with stocks like, let's just say Coca-Cola, right? I mean, it's doing me wrong today because it had a dramatic drop. But look, it usually stays within a very tight range normally, right? It normally stays in different ranges, right? So in those scenarios are best like to sell contracts out of the money. So this way, as time progresses, it's just decreasing the value of those contracts, and I could buy them back at any time, right? I could buy them back at any time. Any questions off of this? I know we covered a lot of it last week, and the same people are here, so that's good because I don't have to kind of reiterate some of the same things. So when I said it's very, very similar to the straddle, the only difference is now we are doing out of the money versus in the money, right? We're doing out of the money versus in the money. So therefore, you could actually take advantage of it, right? The other kind of pros and cons when you're comparing the straddle versus strangle, right? Because they both benefit from the assets moving in either direction, right? They both have unlimited potential. I'm talking about the long straddle and the long strangle, right? They both capitalize, or you you cap how much you could lose. But the strangle is cheaper, right? It's cheaper. It's a cheaper strategy than straddles because the contracts are out of the money, so the contracts are cheaper, right? Now, what are some of the cons of both straddle and the strangle? Well, one, you do need big dramatic changes in the price, right? Because if it does go flat, just like I showed you with the CRM, if we didn't get that big spike and big movement with the stock after hours and it stayed flat, then both those contracts would be kind of worthless, right? They would lose time decay, they would lose volatility, they would lose just premium off of implied volatility and IV crush and so forth, right? But if we do get a big dramatic move, that's how you could really take advantage, right? And they are kind of riskier, right? As far as the straddles and the strangles, they both are risky because it really is a speculative play. Because I just don't know which direction to choose, so I play both directions, right? For the short strangle, could you, in theory, take unrealistic out of the money strikes? Yeah, you can, right? So when you talk about that, let's say out of the money strikes, right? And if you go deep out of the money, 10, 14, 12% on your deltas in both directions, right? What does that tell me? I have an 80% chance of both those contracts being worthless.
I tried to watch your live stream.
Oh, okay.
Can you hear me? I did.
It can. You have to do it on a different device because that's logged in as me. Yep. Sorry about that. Right? But if you go through and go deep out of the money, I mean, sometimes the contract's value isn't, right, $25, right? And let's just say 20%. Well, this one was kind of high because it was actually at that money at closing price, right? But you could definitely see that there is some type of normally there's some type of actual value there. I mean, the potential profits aren't great if you go deep far out of the money.
I could do it on my laptop.
Okay. Right, so you have to kind of go far. If you go far out of the money, that's less money you could potentially make. But sometimes it's worth it. If you want to try it, that's very much how you can do it without risking a lot of money, right? Do you hold short strangles longer to use time indicator to make money on this strategy? You can. You can, right? Because don't forget, every single day it's going to decrease the value of the contract. So if I say, okay, if I bought this all the way over here, so every day is decreasing the value of the contract, I could hold it longer and longer and longer. But also don't forget, every day I hold it, as it consolidates, sometimes that's usually when it expects a big move in either direction, right? But let's just say the squeeze already occurred, right? And this was already telling us for the past couple of days that a squeeze was tightening up because of earnings. And then it finally popped off and squeezed up, right? So as I start to get that squeeze indication, and we've been kind of trading in this range, that's when I could buy the contracts back, right? Utilize some of these tools to kind of take advantage of that opportunity sometimes. Does that make sense? Right? Would you want to sell where you see volume if you go far where the contracts you're selling contracts get bought? Yeah, I mean, you always want to sell with volume, right? You always want to sell, you always want to buy with some type of volume because you want to make sure that either there's going to be buyers there to buy them from you or sellers there to sell them to you, right? So you don't want to kind of, you always want volume, right? Right? You always want some type of volume that's there, right? You don't want to kind of portray it and make sure that just because it's low volume, if there's low volume at a contract, then the chances of them not buying it is gonna be greater, right? So even though you wrote the contract, how is it gonna be to try and buy it back? Right? You want to pick expirations that are close. You don't want to pick expirations that's, I mean, it really depends on my technical analysis, right? So, and that's why I said for this situation here, if I went through and by this close of this contract, right? By the time that this market actually closed here, I could have said that, okay, maybe 170 call, right? With a 160 put. And it closed at 165. So it's $5 out of that and $5 out of that because it could run down to this support base or it could have ran right back up here to this resistance that was over here at 170, right? So I kind of traded within those ranges. So this way, if it does finally break out of this range that it was trading in, it would spike up to that 170, previous resistance all the way over here before it found this tight range. Right? Before I found this tight range, or I could have went right back down to this 160. So I use my technical analysis to see potential areas that I see those contracts, right? So this way I could actually see where those contracts could actually potentially be in the money. Even though I bought them out of the money, because I still want to try to reap the benefits of if they get in the money, the amount of those contracts are going to be extremely valuable, right? So that's how I kind of play it out, right? I've been, okay, I use technical analysis, yet that even though it's out of the money, if it does break this range, that's the next potential price target I see it at. If it does break this range, that's the next potential price target I see it at, right? So I want to make sure that those are the price targets I see. And now if I go in those actual option chains and I see the volume is pretty decent in those areas, the volume and an open interest in both those directions, therefore that's when I want to go ahead and say, okay, I'm going to buy those contracts, right? I'm going to buy those contracts. Does that make sense, Kyle? Yeah. Hi, son. He's crazy. He be on YouTube shorts and shit, and he wants to jump on and watch me live. He been wanting me to teach him. 8 years old and wants me to teach him how to trade. Right? I've been trying to sell Arvo contracts, but nobody wants them. Well, I mean, the stock price is at 27 cents, dude. I wouldn't want it either, right? I mean, you figure you look at it, it has 50 cents and $1 are the new next two potential strike prices, right? And that's basically have to gain 100% for the stock or 300% for the stock, right? To actually kind of get at the money. So it's really, really hard. Look, there's really no volume in those contracts. So some of those shares or some of those contracts are really, really hard to sell, right? You would need a huge, huge move on that stock for it to actually kind of be some type of value.
Can I be in it?
It's not showing me right now.
But can I say hi?
Yeah.
Hi.
So he wants to say hi. Yeah, there's absolutely no volume, right? So that's where some of those contracts and volume is king, right? You have to pay attention. Right, you have to pay attention to those actual I mean, you're probably upside down in those positions. Now you're trying to sell cover calls, so I understand it, right? But you have to wait on a big move, right? On a big move. So for instance, if we go back to that company, so it's been selling off. Now if this runs all the way back up here towards 38 cents here, which basically gains 50% of the actual contract value, then you could probably sell that 50 cents or even potentially the $1, right? But it's really hard to sell calls, at least cover calls, when the stock is oversold, right? Because this stock has just been going down, down, down. So you have to patiently wait for it to run up, and that's when you sell a cover call to try to really maximize, because there's probably going to be some type of volume at least in it, right? But right now, as the stock is going down, nobody wants to buy a actual contract that would have to have 100% return on investment on the actual stock just for that to be at the money, right? So there's only five contracts that are bought and sold today on that actual company, right? So I don't want to talk shit, but that's shit. You know, I still love you, Fausto. Right? What other questions do we got? Yeah, I understand. You're probably stuck in that position. You probably want to just try to make some money out of it. So does that answer everybody's questions? Does that kind of help you out understand that process, right? So there's long straddles, short strangles. I'm sorry, long strangles, short strangles, right? And the difference between the two, right? Is you're a buyer or seller, right? With the buyer, you actually have unlimited. And I've always been very, if you guys ever been to any of my classes, right, you always know that I'm always about selling contracts, right? I'm always about selling contracts because time is now on my side. But in these two scenarios, right, my tidbit, my thing about it is I don't like them because my max potential loss is unlimited while my max profit is capped, right? Well, my max profit is capped, but my max potential loss is unlimited. When I now sell a cover call or cash secure put, I know my max profit is still capped, but my max loss is really only if the stock goes to zero. And those shares that I'm usually buying or selling aren't going to zero, right? The risk to reward on those short straddle strangles just don't really speak to me. Yeah, it doesn't, right? And that's the thing is it's not for everybody, but doesn't mean that you can't still do it, right? Doesn't mean that there's still not an opportunity sometimes to do it. Because when we have these sideways conditions like it was here, these sideways conditions here, right? This is this is a lot of chop, right? So when we're getting a lot of chop, a lot of just horizontal movement, you can still make money by selling an out of the money position, right? Or when I talk about it here in 3 weeks, when we talk about iron condors, which is almost very similar, where I'm kind of selling a call credit spread and a bear credit spread, right? So it makes sense in that factor, right? Where you can still make money even during chop, right? Because now the reward factor or the risk factor isn't really there, right? Sold a $6 put on E-turn today to get the wheel started. There you go. There you go. I like it. I like it. You're speaking my language. Right? Now that's not bad. Right? That's not bad. Look, we say, okay, $6 put. Look, it has a strong support base here at $6. So this, or like $5.97, right? $5.90. So this way, if it does drop below $6, okay, go ahead, execute it. But it's been trading between $6 and $10 for almost the past 3 years, right? Between the past 3 years, it's been trading between $6, $11, $6, $10, $6, $9, $6, right? So that's not a bad scenario to try to learn the process, right? I'm kind of getting out of the strangle and straddle, but this is kind of what you look for, right? This is kind of what you look for when stocks are completely kind of oversold and looking for that bounce up, but you don't mind owning it if it does need be, right? And this has earnings. Or I'm sorry, and this even provides dividends. So if it does execute and you own shares, now you could even get dividends, right? So now if I sold an option contract, right, 30 to 45 days, well, this one's 50 days out, $6 put, right? It might not seem like a lot here, but now I can go ahead and sell some contracts at 30 cents, receive $30 per contract I sold. So this way, if it does execute, now that 30 cents I received drops my overall value to $5.70 per share. That's fine because I already said that it's been trading between $6 and $12. So if I have a $5.70 overall cost base, as long as the stock stays above $5.70, I'm going to be net profit, right? I bought some shares. Hey, that's how you do it. Good job. Proud of you. All right. It doesn't take a lot to start that strategy, but it definitely is a proven strategy that works. All right. All right. What else we got? What other questions? I mean, kind of covered it. Real kind of simple. It's not very difficult. I like the straddle. I like the strangle. But whenever you're doing that strategy, I always recommend you do it with money that you don't mind losing, right? With money you don't mind losing, just in case the stock stays flat. But majority of the time, whenever you do it, you expect probably huge, big moves during CPI information or during some type of earnings, right? Now, there is sometimes with earnings, they stay flat, right? There's sometimes with CPI, it spikes up and then spikes down and then ends up basically flat, right? So those are the risks that's there. But if you do it with profits that you're willing to lose with unlimited potential, right? Like I said, that one day where I risked $400 and I made $16,000. That's a nice return on your investment, right? That's a nice return on my investment. And I was very much willing to kind of risk that $400 as is, right? I mean, $400 is not something to kind of cough at, right? Not something to kind of joke at. But at the same point, if I was willing to lose it because those were profits, then I could go ahead and turn that $400 into a 4,000% return on my investment. That's very much worth it, right? So you expect one of the positions to basically go to zero. Yeah. Yes. Right? So his question was, in this scenario, do you kind of expect one of those positions kind of go to zero or down 80, 90%? Yes, I do. Right? I do. But long as that other one could overcompensate it, right? then I could be net profitable. So just in that same scenario, right? The same situation what I talked about here, on the long strangle here. So if I spent the dollar, right, 50 cents for the call, 50 cents for the put, my total value I spent was $1. Now, if that call is now at $1, $1.20, $1.30, $1.50, $2, right, $8, whatever it might be, that it continues to spike up, most likely this put is probably going to be at 0, right? But that's okay because I made my money back, which was my total $1, plus if whatever this is above $1 is all profits, right? So absolutely, right? That's usually what I expect whenever I trade one of these positions. But if I could get a day where they have, right? So for instance, when I done this before, let me see, it was this day, I think. Right? So for instance, in a scenario where you could expect volatility in both directions, right? So for instance, if you did it here and then it ran up, you sold the call, and then all of a sudden it drops down dramatically, and now I can sell the put for potential profits, or maybe even the next day, right? So there's scenarios where you can make money in both directions, but usually whenever I trade the strategy, long as I can make money in one direction is usually what I anticipate, right? Would this be good for 3/20/23? Oh, during the Fed meetings and when they talk about the interest rates? Yeah, it would be, right? And that's what I talk about sometimes during the Fed meetings, right? And I say, oh, how I'm playing this. During my Sunday lives when I say, hey, how I'm going to play this Fed meeting, right? This FOMC meeting or Jay Powell speaking is I'm playing a strangle, right? And I said, okay, I was going to buy a 405 call and buy a 395 put. So this way, if it strikes up to 405, I'm going to be profitable. If it drops down to 395, I'll be profitable, right? But if it went flat, then that's where I can maximize my losses. So absolutely, that's how I kind of play that, Tammy. It's still cover call season. Yes, right. It's always cover call season. But it really depends also on now your ability to see where those are at, right? Right. It all depends on where those stocks are, and what category or what section is actually running up, right? Let's see what else. Thanks for your teaching, Manny. All these classes help very much. Oh, you're welcome. Appreciate it, Kyle. Pfizer went below 20 RSI and daily. So I was watching that the other day, and I mentioned that I think on Sunday or Monday to somebody on Pfizer. I was already looking at selling some puts on it. Right, selling some puts. I was thinking about selling a $40 or $35 put. But yeah, it's still dropping, right? And I had noticed that there's a strong kind of support base over here at 40, so that's why I said $40. Because if it does drop below 40, then it could drop all the way back down here to 37, right? So that's why I was saying, all right, $40 or $35 put. This way, if it does hit 40, execute, and then continue dropping, right? Then maybe I'll just buy some more shares, kind of average down. But yeah, it's not looking bad for actually selling puts for Pfizer, right? And the main difference between Strangle and Straddle is it's cheaper. Yes. Yep. They're both the same type of strategy as far as it's neutral. You expect both big movement in either direction, right? But the straddle, you're buying it at the money, right? You're buying at the money calls and puts, but a strangle is out of the money calls and puts. That's the difference. So whenever you buy it out of the money, those contract prices are cheaper. But you also need a bigger move when it's out in the money to be profitable, right? So even though the Strangle is cheaper, you also need a bigger move for those contracts to be profitable. For earnings, how far out would you usually go? It really depends on when those earnings are. If the earnings are like Monday afternoon, I don't mind doing weeklies, right? If the earnings are like Thursday, then I'll probably be looking at the next week, right? Or even a couple weeks if I don't want to get affected by the IV crush for both directions, right? So you have to look and play that off, right? So if even if I was looking at snow today, right? Even if I was looking at snow today and understand the concepts of what these if I looked at my IV and say, okay, just for this week, because of earnings, my average IV is at 172%, right? But yet, as I get further out, my IV decreases, right? My implied volatility. So the further out, the less I have effect on my implied volatility. So it really depends on you and your comfortability if you want to get affected by your actual IV or not, right? And for FOMC on SPY, usually, yeah, I mean, usually a couple of days. If I'm trading it, if I'm using it as like a scalp trade, right? If I'm using it as a scalp trade, then yeah, I will kind of go 1 day, because usually the 0 days expiration or even 0 day expiration as it comes out like towards 2 p.m., right? Eastern Standard Time, those 0 days are going to be cheap, right? Because they only have 2 hours before expiration. So I could even get somewhere closer to at the money, right? Or even do a straddle versus a strangle, right? Because those contracts are going to be cheaper. And then you always usually expect a spike in both directions. So it spikes up in one direction, I could sell the call, and then as it sells off, I could sell the put and maybe even make money in both directions, right? So that's how you can kind of play it out, and hopefully it works out in that scenario, and it usually does. Because every single time Jay Powell comes out there and speaks, or the FOMC meeting is out there, right? You see either big sell off and then a spike up, or a big spike up and then a sell off, right? So if as before, and like I told you guys before, like an hour before those meetings occur, when it's just choppiness and it's flat, then it's within an hour, people start to position themselves for those trades. So either then we start to get a run up or even a sell off before the actual the Fed meetings, or even Jay Powell speaking, or whatever gonna occur. So I buy it when it's flat, right? This way, both positions are cheaper, and then soon as it runs up and starts to spike up, then I'll sell the call. Take my profits on the call. Sometimes before it even speaks, it already runs up, and I could already be 100% on my call, which means I already basically recovered all my initial investment. And then as soon as we sell off, now the put is profitable, right? And now I could be net profitable in both directions, right? So there's always a way to kind of play it out. So anything else? What other questions you guys have? If not, I appreciate you guys. I'm jump off, but I'll hang out for a quick minute to see if anybody else had any questions. As always, appreciate all the knowledge you share and the time you take. Yep, thank you. All right. If you guys can, like I said, just continue sharing my content. If one on my